In the world of investing, there's a straightforward path to building wealth that often gets overlooked. Index fund investing. It's not flashy, it doesn't involve predicting the next hot stock, and it doesn't require you to be glued to financial news channels all day. It's a methodical, patient approach that rewards those who are willing to play the long game. It certainly won't make you rich overnight, but for those seeking a reliable, low-cost, and effective way to grow their money over the long term, index funds are the unsung heroes of the investment world. They are designed to mirror the performance of a specific market index, such as the S&P 500, which means you are essentially investing in a broad swath of the market. They offer a simple yet powerful approach to capturing the market's returns, without the complexities and risks associated with stock picking or expensive actively managed funds. By spreading your investment across a wide range of companies, index funds reduce the risk associated with putting all your eggs in one basket. Many investors, both novice and experienced, get caught up in the allure of beating the market, seeking out the next Apple or Amazon. They spend countless hours researching, analyzing, and trying to predict market movements. But the reality is, consistently outperforming the market is incredibly difficult, even for professional investors. The stock market is influenced by a myriad of factors, many of which are unpredictable. Economic indicators, geopolitical events, and even natural disasters can cause sudden market shifts. This makes the task of picking winning stocks not just challenging, but often a matter of luck rather than skill. Index funds, on the other hand, offer a different approach. They don't try to beat the market. They aim to match it. By doing so, they eliminate the need for constant monitoring and adjustments. This passive investment strategy allows investors to benefit from the overall growth of the market, without the stress and time commitment of active trading. And in doing so, they provide investors with a reliable way to participate in the long-term growth of the stock market. Over time, the stock market has historically trended upwards, despite short-term volatility. This means that by staying invested in index funds, you can ride the wave of market growth and build wealth steadily. This straightforward approach, combined with their low costs and tax efficiency, makes index funds an ideal investment vehicle for building wealth over time. The low fees associated with index funds mean that more of your money stays invested, compounding over the years. Additionally, their tax efficiency can help you keep more of your returns. For those who are looking to secure their financial future without the stress and complexity of active investing, index funds offer a simple, effective, and time-tested path to wealth. By embracing this approach, you can focus on what truly matters in life, knowing that your investments are working for you in the background. Imagine a giant mirror reflecting the entire stock market. This mirror captures every rise and fall, every twist and turn, and every single movement of the market. It's like having a snapshot of the entire financial landscape at any given moment. That's essentially what an index fund does. It mirrors the performance of a specific segment of the market, providing a comprehensive view of that segment's overall health and trends. It's like a basket of stocks designed to track a specific market index, such as the S&P 500, which comprises 500 of the largest publicly traded U.S. companies. This basket is carefully curated to represent the market index as accurately as possible. The S&P 500 is one of the most well-known indices, representing a broad spectrum of industries and sectors. When you invest in an S&P 500 index fund, you're essentially buying a tiny piece of all 500 companies in the index. This means that your investment is spread across a wide array of companies, from tech giants to healthcare leaders and everything in between. This broad exposure can be a powerful tool for building a resilient investment portfolio. You're buying a tiny piece of all 500 companies in the index. This approach offers several advantages. First, it provides instant diversification. Instead of putting all your eggs in one basket by investing in a single stock, you're spreading your risk across hundreds or even thousands of companies. This diversification helps to cushion your portfolio against the volatility of individual stocks. If one company performs poorly, the impact on your overall investment is minimized because other companies in the index may perform well, balancing out the losses. Diversification is a key principle in investing, and index funds make it easy to achieve. By holding a wide variety of stocks, you reduce the risk associated with any single investment. This can lead to more stable and predictable returns over time. Instead of putting all your eggs in one basket by investing in a single stock, You're spreading your risk across hundreds or even thousands of companies. This strategy helps to mitigate the impact of market volatility on your portfolio. You're spreading your risk across hundreds or even thousands of companies. This diversification helps to cushion your portfolio against the volatility of individual stocks. Second, index funds are passively managed. This means that instead of having a team of portfolio managers actively buying and selling stocks in an attempt to beat the market, index funds simply track their designated index. This passive management approach has several benefits. Second, index funds are passively managed. Unlike actively managed funds, where portfolio managers constantly buy and sell stocks in an attempt to beat the market, index funds simply track their designated index. This passive approach results in significantly lower fees. Actively managed funds often come with higher fees due to the costs associated with frequent trading and the salaries of the portfolio managers. In contrast, index funds have lower operating costs because they require less hands-on management. Index funds simply track their designated index. This passive approach results in significantly lower fees, which can have a major impact on your returns over time. Lower fees mean that more of your money stays invested and can grow over the long term. This passive approach results in significantly lower fees, which can have a major impact on your returns over time. Over the long term, these cost savings can add up, potentially leading to higher overall returns for investors, which can have a major impact on your returns over time. By keeping costs low and providing broad market exposure, index funds offer a simple yet effective way to invest in the stock market. They are a popular choice for both novice and experienced investors looking to build a diversified and cost-efficient portfolio. One of the most compelling reasons to invest in index funds is their low cost. Unlike actively managed funds, which require a team of analysts and portfolio managers to research and select stocks, index funds simply aim to replicate the performance of a specific market index. This passive management approach significantly reduces the operational costs associated with running the fund. Actively managed funds charge high fees for their stock-picking services, which can include management fees, administrative fees, and other operational costs. These fees can add up quickly, often amounting to 1% or more of your assets annually. While 1% might not sound like much, it can have a significant impact on your investment returns over the long term. For example, if you have a portfolio worth $100,000, a 1% fee would cost you $1,000 each year. Over a decade, assuming your portfolio grows, these fees could amount to tens of thousands of dollars. This is money that could have been compounding and growing within your investment, but instead, it goes to the fund managers. These fees eat into your returns, reducing the amount of money you ultimately accumulate. The higher the fees, the harder it is for your investments to grow, especially in a market where returns can be volatile. This is why minimizing fees is crucial for maximizing your investment returns. Index funds with their passive management style have significantly lower expense ratios. These funds don't require the same level of active management, which means they can operate with much lower costs. In many cases, the expense ratios for index funds can be as low as 0.03% per year, or even lower, often as low as 0.03% per year. This means that for every $10,000 you have invested, you might only pay $3 in fees annually. Over time, these savings can add up, allowing more of your money to stay invested and grow. This difference in fees may seem small, but it can add up to substantial savings over time. Consider the impact over 20 or 30 years of investing. The money saved on fees can be reinvested, compounding and growing your wealth even further. This is one of the key advantages of index funds, leaving you with more money in your pocket. The lower fees associated with index funds mean that more of your investment returns stay with you, rather than being siphoned off by fund managers. This can make a significant difference in your overall financial health and your ability to reach your long-term financial goals. The impact of fees on investment returns is undeniable. Numerous studies have shown that lower fees are correlated with better investment performance. This is because the less you pay in fees, the more of your investment returns you get to keep. Over time, this can lead to significantly higher overall returns. A study by Morningstar found that low fees were the most reliable predictor of future mutual fund performance. This means that when choosing between different investment options, looking at the fees can give you a good indication of which funds are likely to perform better in the long run. In other words, the less you pay in fees, the more money you keep. This is a simple yet powerful concept that can have a profound impact on your investment success. By minimizing fees, you maximize the amount of money that stays invested and continues to grow. And the greater your chances of achieving your financial goals. Whether you're saving for retirement, a child's education, or any other long-term objective, keeping fees low can help you get there faster. It's a fundamental principle of investing that can make a big difference in your financial future. This is a fundamental principle of investing. By focusing on low-cost investment options like index funds, you can improve your chances of achieving your financial goals. It's a strategy that has been proven to work over time and is embraced by many successful investors. And it's one of the key reasons why index funds have become so popular, particularly among long-term investors. By keeping costs low and allowing your investments to grow over time, index funds offer a simple yet effective way to build wealth and achieve financial success. Even Warren Buffett, arguably the most successful investor of all time, is a staunch advocate for index funds, emphasizing their long-term benefits. In 2007, he famously wagered $1 million that a simple S&P 500 index fund would outperform a portfolio of hedge funds over 10 years. The results were decisive and clear. The index fund, with its low fees and broad market exposure, handily beat the actively managed hedge funds, proving its efficiency. Buffett's bet wasn't about proving index funds are guaranteed to outperform every year. It was about demonstrating the power of simplicity and the drag that high fees can have on investment returns over time. Actively managed funds, despite their promises of market-beating returns, often fail to deliver, and their high fees further erode any potential outperformance. Index funds, on the other hand, provide a low-cost, efficient way to capture the market's returns, making them a compelling choice for investors of all levels of experience and knowledge.